I've been getting some emails with regards to backtesting candlestick patterns, and I can understand where they come from because the YouTube gurus has been uploading lots of videos on candlestick patterns and how it's successful, like some of the clickbait titles, including like the best candlestick patterns at work and things like that. But in all due fairness, most of these patterns don't really work, as there's no scientific evidence predicting its success. In fact, there are many research papers which actually conclude that it actually doesn't work. So this is one of them, which they did in the Vietnam stock market, and their conclusion was it doesn't really predict the trend and generate profitability in the stock market in Vietnam. I also found another research paper. This was in Sage Open, and there too the binomial test results also indicate that candlestick patterns cannot reliably predict market directions. So the reason why it is getting lots of attention among the retail traders is that these trading gurus kind of use something called bias. I think it's in behavioral economics, it's called selection bias. So what they do essentially is that they kind of find areas where the hammer works and shows the chart, say, look, here there's a hammer and the market is reversed, and they kind of conclude that, yay, look, it works there. So there's a hammer here, but then the next day the market is going down. I can show you another example during the coronavirus crash, where there was a hammer there and the market didn't reverse. There was another hammer there and market didn't reverse pretty much immediately. So what I did is that I essentially tried to put this into code. So what I believe is that any strategy can be back tested and concluded whether it works or not by just putting into code. So what I'm going to do here today is the bullish engulfing pattern. So if I can go to the actual definition of bullish engulfing pattern from Investopedia. So this is technically what we're looking for. This is the bullish engulfing pattern. So we've got the first day, which is like a red day, and the second day the market opens below the close of the previous day and then closes above the open of the previous day. Now let's go a bit deep into the definition. The second candle completely engulfs the real body of the first one without regard to the length of the tail shadows. So there's two important things you have to take away. One is a real body, and the other one is without regard to length of the tail shadows. So I'm going to take away these tails and just focus on the real body. So this body should engulf the body of the previous day. So I've actually coded this. So I'm just going to open my script, the ones that I've coded. So this is the bullish engulfing pattern. So I put this into code and I've run this. So the advantage of coding this is that we get to remove the subjective aspect of the bullish engulfing pattern. So one of the foundations of bullish engulfing pattern is that, or the hammer is essentially that the market has to be a downtrend. So, but the problem with those kind of subjective theory is that downtrend for me might not be a downtrend for you. So for instance, here there's a downtrend, but when you look at it from a long-term perspective, it's not really a downtrend. So by taking away the subjective aspects and by putting like strict rules to it, we can have a better idea on whether it works or not. So I've coded this and I'm going to run this now. I'm going to add this to the chart and I'll just change it to 100% equity to see the actual returns. So we've got 139% net profit with 77% profitable, 2 as the profit factor, and 203% maximum drawdown. So you might tell me like, yeah, it looks quite profitable, but in reality it's not the entries that's actually giving me the returns here, it's actually the exits. So in this case what I've done is I've actually taken the RSI 2 as the RSI going above 90 as my exit. I'll just put it into chart here so you'll get a better idea. Relative strength index, and the relative strength index period that I used was 2. Just going to change the settings to 90 and 100 as well, 90 and 10, because I was looking at the exit as 90. So I'll just go through a few examples here. So on the 21st of April, the green bar completely engulfed the red bar of the 20th of April, and because of that, a bullish engulfing pattern signal was called, and the next day we ended long, and we exited the trade on 30th of April because on 29th of April the RSI was above 90. Let's take another example here as well. So this is on the 18th of March, and on the 18th of March, the 17th of March, the green bar completely engulfed the previous bar of 16th of March, and we ended a long position there, and we closed on 5th of April because on the 1st of April the RSI closed above 90. So if there's any takeaway with this video that I want you to have, is that I don't care if it's a bullish engulfing pattern or a hammer or a bearish engulfing pattern. The key is to find out good exits. If you focus more time in finding out great exits than finding out great entries, I think you've got a better chance of success in trading. But most people out there, they focus completely on the entries, trying to find out unique entries that works and things around those nature. And most of these trading gurus, again, the ones that we saw in the candlestick patterns in YouTube, they are all claiming to have great entries, but they never talk about where to exit, and they kind of sum up the exit as the risk management of 3:1 and 2:1 and things around there. But in all fairness, by having strict rules of exit, you kind of get to know what to do, how the returns will be, and you can also backtest it because now you have strict rules which you can code. So if I can check this in other markets in QQQ again, it seems pretty okay. And this is just a bullish engulfing pattern. I haven't coded the hammer or hanging man or any other candlestick patterns. Let's do it in some of the stocks there. In Facebook, it's given 35%. PayPal. See some of the stocks which it didn't perform well. I'm pretty sure there will be stocks that didn't go well. It seems like I can't find any. But anyways, I think you got the gist of how I have backtested it, but you need to learn how to backtest. Backtesting is quite important. I've got a course here in cornprogram.com which deals with these strategies which has been backtested over tens of thousands of stocks with pretty good solid returns. Now, I don't really care if you don't do the course or not, but regardless of that, I genuinely believe you need to learn how to backtest so that you don't fall prey to many of these YouTube self-proclaimed gurus, because you can really find great strategies by just coding, and then you can just backtest it, see the amount of trades that's been done, even to the tiniest detail on when the trade was done. And TradingView is a great platform. There are lots of platforms out there which allow you to backtest, but since TradingView is used by many people, I really reckon you should backtest. Now, there's a reason why quantitative analysis is quite important. Like if you read some of the Market Wizards book, many of these traders actually backtest. Some of the most successful hedge fund, Renaissance Technologies of Jim Simmons, they do extensive backtesting and quantitative analysis. So these days you have lots of opportunities to do this yourself. You can actually backtest yourself by learning a little bit of coding, I'm not talking about coding, massive coding. Like for instance, this one is just a few lines of code and you're done with this code. So by just doing some basic coding and by diversifying the strategy across different markets, or by coming up with different kinds of strategies, you can really come up with good strategies, and you can even set it up with a brokerage firm and do some great trades. Hope you guys enjoy this video. So if you haven't checked out my other quantitative strategy that I did, and that was backtesting the Stan Weinstein's trading strategy, I'll give the links in the top right of the video. So this is also a pretty good strategy, and I've got lots of good emails from people who have watched this. You can also download it in the video there as well. So feel free to ask me any questions about this strategy, and if you have any any requests for me to backtest any of the strategies that you like, I would like to put it in there. Subscribe for more, because I'll be uploading more quantitative backtesting videos, and I think it can really help you in trading. And stay away from people who kind of preach trading videos without any backtesting results, because if you don't backtest, you don't know any strategy works or not. Backtesting gives you that statistical advantage, that mathematical historical advantage, that hey, here's a proof that it has worked. If somebody tells you this strategy works, and if you don't have a proof, or if you don't have a scientific evidence, you can't trust them. It's just their opinion, and opinions doesn't matter unless you can backtest it, unless you can find out real results. And you can actually go through many of the years where it performed well, especially in the 2008 financial crisis, where you're expecting volatility. Did it do well then? Or during the coronavirus crash in February 2020, did it do well then? So in this, it seems to have avoided the crash completely and performed pretty well. So thank you so much for watching. Hope you have a great day.